Good morning, everybody. Can all of you hear me? Just a show of hands. Okay, wonderful. We'll just wait for a couple more minutes before getting started. All right. All right. I think we have enough participants for today. Of course, we expect more to join as we continue with the lecture. So let's begin. Can all of you see my screen?
Yes.
Okay, wonderful. One thing, guys, it would be really useful if you could turn on your cameras. This is just to make the session more interactive. But of course, it's up to you. Just remember, the session is being recorded so that it can be uploaded online afterwards, so that you can go back and view the lectures again if you need to revise. So first of all, let me actually thank all of you for signing up to the course. I believe this is a very interesting course. This is the third year this course is being taught, and it has received quite some good feedback, and we have tried to improve upon that. And again, I hope all of you are staying well and being safe, following all COVID protocols. I'm afraid I've had to conduct the first 3 lectures online because I'm not in Norway at the moment and I'm kind of stuck somewhere. But from lecture 4 onwards, we'll start to, we'll start to have it more, have the lectures physically. And I'll make sure to record the lectures in the classroom so that, you can continue to view them afterwards if you require that subsequently. So let's get started. So just to give you a brief overview of the course structure. So in total, we have about 10 lectures. It might get extended to 10 or 11 or 12 lectures, depending on how quickly we are able to cover the lecture, each lecture. Alongside, there'll also be about 3 to 4 seminars. And the focus here will be first on solving some numerical problems, maybe some theory as well, just to give you some practice on how to attempt questions related to finance in general. We'll also use some of these seminars to address some doubts that you might have as we proceed with the course. Coming to the assessment, it's partly based on a take-home assignment. So half of the grade comes through that. This assignment will, well, generally it's based on a case study, which I'll provide to you latest by the 7th of March. It will be about a real company. And you will have to investigate the questions that are asked under this case study. And you're expected to prepare a report, not exceeding 3,500 words. And you'll have about a month to work on it. It's a very simple case study. If you follow the classes and read the main course textbook, I think it should be easy to solve the case study. The remaining 50% of the grade comes from a final exam. This is likely to be about 4 hours in total. And it will comprise a combination of numerical questions, a bit of simple theory solving. So you'll be given a model, you'll be given questions pertaining to a model and be asked to solve it and answer related questions. There'll also be some descriptive questions that might be asked, mainly pertaining to, for example, cryptocurrencies or online lending platforms, peer-to-peer platforms, and things like that, which we'll cover extensively in this course. Overall, this is a very easy course. It's possible to get a very high grade, but ultimately that depends on how you follow the lectures, how you revise the material, and obviously how you answer the assignment and the questions. So I wish you all the best and hope you'll find this course very interesting. I personally really love to teach this course. So I find it quite enriching and motivational. All right. Other practical information. So as always, I'll make it a point to put up the material, the lecture slides and everything in advance on Midway. You're welcome to ask any questions via email, or if you need a more extensive discussion, you're welcome to drop by my office, room 314 at the department. And during the lectures, you're also welcome to interrupt me at any time if you have any questions. So I encourage you to answer the questions that are asked, and also to make use of the opportunity to fulfill any queries, any doubts that you might have. So please use the opportunity. Okay. We will use the first textbook called Contemporary Financial Intermediation as the main course textbook. Okay. This is a really good book. We'll cover a very small part of it, but for someone who's interested in kickstarting a career in financial services or banking, this is a really good book to read fully. Alongside, there's also a couple of other books that I would highly recommend. So the other one is called Bitcoin and Cryptocurrency Technologies: A Comprehensive Introduction. Now, this is a more this book was written for a more general audience. But what I would suggest is you could focus on the more economically relevant topics like blockchain, mining, and decentralization and related concepts. So you'll have to be a bit more careful about what you choose to read from this book. But again, I can assure you it's a very simple book to read. Okay. And the third one is this book called Market Design, Auctions and Matching. So this book, it's again, I find it to be a gold mine if you're interested in auction theory and stuff like that. We'll be covering the first three chapters in this book. So we'll be barely scraping the surface of the material covered in this book. So we'll focus on some basics of auctions. So if you're, as economic students, if you have not read anything about auction theory, lecture 9 will be very useful for you. And having understood the basics of auctions, we'll then move on to how financial technology, or fintech in short, is actually revamping the way auctions are conducted. So we'll focus on a specific case study related to eBay. So I hope all of you have known or have used eBay at some point in your life. If not, that's fine. You can simply Google and find out what this company is all about. And this company relies extensively on auctions to sell products to its customers. So we'll see how eBay conducts auctions. Okay. Again, there's financial technology in general. And more specifically, if you look at things like financial intermediation, banking, cryptocurrencies, or auctions, these are heavily researched fields. There's literally thousands of articles out there on each of these important financial technologies. But again, be careful what you choose to read. There's a lot of garbage out there as well, especially blog articles which don't really make sense to the trained mind. So I would really urge you to have this, critical thinking when you're reading something, especially from an online blog, and see whether and try and understand whether that makes sense. As we proceed with the course, I'll be publishing a lot of useful articles, maybe some videos and slides wherever I can find them to help you understand and get interested in fintech better. And obviously, if you come across any related material, please, you're welcome to share that with me so that I can forward it to your classmates. So what will we learn in this course? Well, we'll cover a lot of interesting topics, but the idea in this course is to proceed in a logical manner. So we'll begin by trying to understand why we need money as a society, as an economy. Why do we need money, currency, and how money is exchanged? Okay, so under this, we'll try and understand what is the function of financial markets, and especially financial intermediaries who operate within these markets. Here, the main emphasis is on banking, right? So we'll use banking wherever required as an example to explain the role of financial intermediaries. So banks, for example, are financial intermediaries. We'll see how that works. Then, having understood the traditional role of money and financial markets and intermediaries, we'll focus on how fintech is changing the way traditional intermediation works. So we'll start by discussing things like disintermediation, and then we'll focus on recent innovations that have impacted financial markets. So under this, we'll learn a number of new concepts. We'll learn about securitization. We'll learn about how financing takes place in the modern age, whether it's online lending. So imagine how online lending works compared to a traditional bank loan. So if you want to purchase a house, the question is whether you would approach your bank physically asking for a loan, or whether you would just go to an online lending platform, let's say like Lending Club, and try to purchase your house by raising a loan there. The question is, which of these is better? So we'll try and understand that. Then ultimately, we'll talk about blockchain. I'm sure most of you have heard about what it is, probably don't know what it represents, but must have come across the term somewhere. We'll try and understand what blockchain really is, how it works, and how it led to the introduction, the creation of cryptocurrencies like Bitcoin. And lastly, we'll focus on online auctions, as I just mentioned. During the lectures, you'll be introduced to a number of important and very interesting concepts. Most notably, this thing called information asymmetry. So under this, there's also subtopics like adverse selection, moral hazard, and when we move on to concepts related to the blockchain, that's when we'll start to talk about issues like decentralization, trustless exchange. So the question is, would you exchange money? Would you invest in someone? That is, would you provide capital to somebody based on trust, or can we actually invest in somebody, in a company, for example, in a trustless manner? So how does that work? Is it good or bad? And what role do tokens play in this whole context? So we'll try and understand all these different concepts. Again, there is a bit of theory throughout the course. These are very simple theories, very easy to solve. And so is the exam if it contains theory related questions. So we'll discuss some very interesting theory as we proceed. But my preference is also to use very practical examples throughout the course. So we'll discuss wherever possible using real world examples, just to see how fintech works in the real world. Okay. Topics covered. We have, as I said, about 10 lectures. So we'll start by trying to understand today why we need capital markets, what role or what advantage or disadvantage do they provide. Then from the next lecture, we'll focus on this thing called financial intermediation. So under this, how information plays a role, how credit analysis or due diligence is conducted. And in lecture 4, we'll actually try and understand whether these financial intermediaries, like banks, should actually be regulated or not. Why do banks need to be regulated? That's a fundamental question that all of us need to understand. From lecture 5 onwards, this is where the flesh starts to appear on the bone, right? So we'll talk about how financial markets are being disrupted through constant innovation. So we'll look at disintermediation and reintermediation. And then under blockchain, apart from understanding what cryptocurrencies are, We'll also look at some new emerging technologies based on blockchain itself, like smart contracts, new ways of financing companies or individuals known as initial coin offerings or ICOs. And lastly, as I said, we'll focus on auctions for the last 2 lectures. All right. Any questions so far? No? Okay. Okay, so let's begin this first session with by discussing financial markets. Okay, so to understand the role of financial markets, let me start by introducing you to this very toy model. I'm sure you have seen this in some of your earlier lectures. This is known more traditionally as the circular economy. What does it comprise? It comprises 2 types of actors. On one end, you have households, like people like you and me. And on the other hand, you have firms, which basically produce certain goods and services and offer that to households. So what do households provide? They provide certain factors of production, right? I mean, you and I, we need a job at some point in life to have a good, decent standard of living. So therefore, we provide labor. We also need we also have real estate. We can provide certain other factors, and like our house or some kind of a factory or whatever. And more importantly, some of us also have money which we want to invest and hopefully make a return on it. So households provide basically 3 types of factors of production. One is they offer labor, they offer land, more generally physical resources, and they also provide capital. Okay. What do firms do? Firms, on the other end, they accept these factors of production, they transform these factors, and then provide certain goods and services using these factors of production. Who do they supply these goods and services to? They provide it to the households, right? So the households purchase these goods and services. And how do they do that? They do that by taking the wages and dividends that these firms also return to the households. So wages, because you and I, we contribute labor, and the way we get compensated for providing that labor is through wages. If I invest money into a firm, I expect to receive some payment, some return out of it. That's issued in the form of dividends. Okay, so this is how the circular economy operates. Now, let's introduce a question. What if we don't want to work 24/7? We don't want to provide the maximum labor that we can provide, or we don't want to invest our entire wages in the form of capital, right? We don't want to provide our entire wages to firms because we want to save some of our money. So what happens in that context? Any questions? Sorry, what happens in that context? Any answers? What happens to the firms? Now, earlier, firms were receiving the entire labor input, the capital input, and the land input from the households. Now, households are cutting back on that. They are saving some money for their future, for their own purposes. They're not providing their full labor. So, what happens to the firms?
They produce less products.
Use your if you could respond by voice, because it's difficult for me to monitor by chat. Yeah,
they produce less products, and in market there will be lack of products and the prices will increase.
Yeah, but what if, let's say, firms want to produce the same level of goods and services? What happens in that context?
It will be more expensive for them to produce one unit, and if they remain in the price, the income will be cut.
All right. That's slightly more complicated than the toy model, the simple model which we have here. That's obviously true what you said. But here, what happens is firms were earlier deriving their entire capital, their entire money requirements from households. Now, when households cut back, firms face a deficit, right? They face a capital deficit. and they need to raise that deficit from somewhere. They need to plug that deficit by raising money from elsewhere. So there's a shortfall that firms face, which they need to obtain from somewhere else. Households, on the other end, their objective is to invest that excess, that part of the wages that they received somewhere and hopefully get a return on it, right? So what do most of us typically do when we receive our wages? We store a part of that in the bank as a deposit and hope to get some return on that. Now, obviously, today's banks don't provide much return on your savings, but usually in the general sense, in the traditional sense, households save part of their income in let's say in a bank in the hope of getting some return on it. Why don't households save that money themselves? Like, why don't they store it in their own homes?
Because they won't earn anything with this money storing them at home, and bank will pay them procents.
Yeah, and more importantly, it's also not safe to save your money at home. There's a storage problem. There's also a serious risk of theft. That might not be an issue in Norway, but in other countries, it is a big issue, right? So safekeeping of your money is also an important consideration. So this is where the role of financial markets comes into play. Now, again, I'm not talking with respect to banks, right? I'm talking more generally with respect to this intermediary coming into play, which is known more broadly as a financial market. Okay, so what do financial markets do? They recognize that households want to save their money safely and want to obtain a return on it. So they provide one service by accepting the savings of these households as deposits, right? What happens to firms? Firms can also access these financial markets in order to fulfill that shortfall, that funding shortfall. Whatever capital they needed to raise and they couldn't raise from households, they now can go to the financial markets and raise that money, right? So what do financial markets do? What kind of service do they provide? They're basically acting as an intermediary, a third party between households and firms. They are accepting certain savings from households, and they are issuing that as an investment to firms. Now, that investment can either be in the form of debt, in the form of loans, or if you have any other type of financial intermediary, like let's say an investment bank, they typically buy shares in that firm and provide the money to the firm, right? So we don't care about what kind of investment happens here, but basically the money saved by households is getting transformed and being invested into the firms. So what happens? Even though households cut back on their savings and firms face a funding deficit, the emergence of financial markets keeps the circular economy flowing, keeps it running. So this is a very, very basic explanation of why financial markets are really required in the real world. Okay. Now, broadly speaking, financial markets can be termed as places where assets of different types are bought and sold. So your typical assets can include stocks or bonds. Bonds are basically loans more generally. Even currencies like euros, pounds, and Norwegian krona are traded in forex markets and foreign exchange markets. And more recently, you have cryptocurrencies like Bitcoin and Ethereum. These are also traded in certain financial markets, certain crypto exchanges, even with traditional currencies like US dollar or euro. Okay, but more broadly speaking, financial markets are basically meeting points. They are matching markets between investors who are basically capital providers and businesses or individuals who are capital seekers, who need capital but don't have it with them. So there are tons and tons of examples of financial markets. Your Oslo Börs or the London Stock Exchange or the New York Stock Exchange are one example of financial markets where shares in companies get traded. Okay, your commercial banks are another type of financial market, right? It's basically a market which is matching certain depositors with certain individuals and firms who seek loans, right? You also have financial markets where certain commodities get traded. For example, commodities like food grains, oil, metals, all these also tend to get traded, most notably, in places like the Chicago Mercantile Exchange. Cryptocurrency exchanges, again, as I said, that's another example of financial markets. You have tons and tons of crypto exchanges today, like Coinbase, Bitfinex, Binance, and whatnot. We'll see how interesting this crypto world really is. And lastly, some of you might have heard of this platform called Kickstarter, which is used to fund projects. So Kickstarter is a platform that pools money from thousands of individual small investors and tries to fund a project. So these are more generally called as crowdfunding platforms. And these are also an example of more recent financial markets. Okay. Now, if you look at it more closely, if you focus your attention from financial markets into who financial intermediaries are, these are basically institutions that facilitate the exchange of capital between parties, right? We saw that in the example of the circular economy, where firms are, where intermediaries are basically funneling money from households to firms in one way or the other. So they basically help allocate funds that they receive from households or some investors towards the best investment opportunities. So it's not as if every firm that seeks a loan will get funded, right? Only those firms that have good projects that have good projects with good returns will likely get funded. So that's where a financial intermediary plays an important role in allocating funds towards the best investment opportunities. Apart from this, intermediaries also provide additional services. They reduce the risk of investment, which some of us cannot do. Like you and I, we know how to deposit our money in a bank, but you and I, we don't know how to issue a loan in the best possible manner. So what a bank is basically doing here, an intermediary, is also managing the risk, minimizing the risk as much as possible when making that loan. And ultimately, your deposits are safeguarded by the bank. They're guaranteed against theft, and therefore intermediaries also provide safe storage of your money. And they, in providing all these services, they provide significant cost advantages. We'll see this in the second lecture with a very nice example of the marriage market. But broadly speaking, it's very difficult, as I said, for us to find a borrower on our own. We have to expend a lot of resources, a lot of time and money in order to find the best possible borrower, whereas banks and other types of intermediaries are more specialized in finding the most suitable investment or borrower. Okay. Broadly speaking, financial intermediaries can be classified into two different types. On one hand, you have commercial banks. They basically perform the role of taking your deposits, taking your savings, and lending them out as loans. So their operations are very simple to understand. On the other hand, you have other types of financial intermediaries that are more specialized, that provide a very niche service of investing in a certain type of company or in a certain type of market. So hedge funds will only invest in very risky opportunities. Venture capital funds invest in startups. Private equity firms buy mature companies, established companies, and hope to make them more profitable in over the next few years. So you can see different types of intermediaries provide different types of investment opportunities, and they allocate capital differently depending on their business model. What are some of the key functions that financial markets provide? Basically, one key objective of financial markets is to allocate capital most efficiently, and they need to do this across time, right? When you deposit your money today, you deposit that in the hope of making some future returns, right? You hope to get some returns in the future. So when it comes to saving, capital allocation has to be efficient across time. Similarly, when you borrow loans, when you borrow money from a bank in the form of a loan, you're basically borrowing money to fund your current expenditure, right? You're borrowing money, for example, to purchase a house today, but you keep repaying that money over the next few years. So again, lending and borrowing needs to be performed efficiently across time. Same thing for investing. When you buy stocks of a company, you become a shareholder in that firm, and you're basically buying shares for what purpose? Why do we buy shares in a company? What is the purpose?
Well, we expect some sort of in exchange, the company receives funding for possible future investments that inevitably will expect it to grow the company itself.
So what happens to the firm's shares if the firm, let's say, grows over time? If the firm's projects return high yields, high returns, what happens to for example, the share price?
Well, it can increase, of course.
Yes. So one of the key objectives to buy stocks of a company is the hope that the share price of the firm of that company will increase in the subsequent period, right? That's how you make money, by buying the shares of a company in the form of capital gains. So in the financial world, this increase in the share price and the return you get as a result of that increase in the share price are known as capital gains. Okay. You also need to take account, so financial markets also need to take account different possible states of the world in the future. Now, imagine a firm receives a loan and promises to repay that over the next 10 years. Now, it is equally possible that the firm might find itself 10 years down the line in a good situation or a bad situation, depending on the economy, depending on how well its business is performing, whatever. When times are good, what happens? The firm performs really well and its assets appreciate in value, right? All its projects are doing really well. Naturally, the share price will increase and the firm makes possibly good profits. So in that situation, it is much more easier for this firm to repay all its loans. And even shareholders will be happy to invest more money into the firm because they make high returns. But what about bad times? When the firm is not doing really well, it can make losses, or it can even go bankrupt. So in that situation, it may not be in a position to repay its loans, and even shareholders might lose money if the stock price goes down. So therefore, capital allocation also needs to consider possible states of the world in the future. That's an important investment objective. Okay. Another important function of financial markets is information production and price discovery. So information, as they say, is key, right? So if you go to a bank requesting a loan, what is the first thing that the bank asks you?
Everything about your background so that you will have money to pay the loan back.
Yeah. Well, so it might ask you about your wealth. It might ask you about your current position, how much salary you make, whether you have had any bankruptcies or insolvencies in the past. It will also ask you information about your credit history. What is all this information, right? This is all information, right? The bank is using that information about you to determine whether to issue you a loan or not. So this is broadly known as due diligence. Okay. The bank also needs this information to determine how much interest rate to charge on the loan. So the way this is done is through credit analysis. We'll cover this more extensively in lecture 3. If you're a firm and you're requesting a loan to fund a certain project, the bank needs to determine how risky that project is. What is the minimum expected rate of return you would make by pursuing that project? So again, when it comes to venture capital firms who invest in startups, the question again is, how would you value a young company, a startup? Would you invest in that startup or not? That decision depends on how much information a venture capital firm can obtain about that company, how it has been performing so far, who are the entrepreneurs behind that company, who are the founders, how well have they been doing, how much funding they have raised in the past. All these are pieces of information that future investors, future lenders, future, let's say, capital providers will need in order to make an informed investment decision. Similarly, when someone tries to raise money over the internet, either through crypto related methods or through crowdfunding like on Kickstarter, again, it all depends on how much information you provide. So another key function of financial markets is information production and price discovery. Price discovery is basically a mechanism to value the viability of a project, of an investment opportunity, and decide whether to invest or not. Okay. Now, we'll quickly cover some key theories on financial markets, on how financing occurs. Theories surrounding how financial markets operate can be broadly classified into two types. One is the classical view, the more traditional view, and one is the modern view. And the modern view can itself be split into two types. One is the neoclassical, and the other is the neo-institutional framework. Now, looking at the classical view, by the way, before I proceed, any questions so far? I think you need to understand the role of information and its importance for financial markets to operate smoothly. Do you have any questions on that? Okay. Again, I'd like to keep this as interactive as possible. If you have any questions, doesn't matter how stupid you might think it is, just ask. Don't feel shy. Okay. Looking at the classical view, this was proposed. This whole classical view of how financial markets work was proposed prior to the Second World War. Okay, in that era, finance was actually treated as a second-class citizen. It was considered secondary to understanding how firms produce goods and services. So the emphasis of economists back then was how efficiently can a firm produce goods and services, and how they can sell them. But the whole notion of how firms finance themselves was not given much thought. In fact, it was not seen as very important how the firm funded itself to produce those goods and services. Would the firm use more loans, or would the firm raise more money, for example, from the stock market in the form of equity? There was no intuition about it. What was the cost involved in raising money as loans versus stock markets? That was also not given serious thought. Of course, one key thing you have to remember is that accounting was seen as a key corporate function. So all cash flows occurring within the firm and within and outside the firm would be recorded thoroughly, but these provide a historical perspective of how the company has been performing. So for example, if you take modern financial statements like your income statement, right, it basically shows how much money the firm made through how much revenue the firm earned. And if you scroll down the income statement, you will see how much net profit the firm made eventually. So this is basically giving you a snapshot of the cash flows that occurred within the firm. Similarly, you have other financial statements that provide a similar service, but these are basically historical in nature. How much did the firm earn over the last 1 year, for example? But during the classical period, none of this information, which is extremely valuable to indicate how well the firm has been performing, was not used for funding, for determining future financing decisions. So nobody made use of all these cash flows and the related information to determine how the firm should finance itself. Should it raise more loans? Should it raise more equity from stock markets? That was not given serious thought. Okay. Now contrast this with the modern view, which started to emerge from the 50s. Here, the focus was not on the firm. It was more on individuals' decisions, right? Here, economists started to question the argument that the emphasis was on the firm, because they reasoned that the firm is just a network of contracts, right? It's a network of contracts amongst individuals who decide to work with each other in a certain way, right? Imagine I'm based at the university, I'm an employee of the university, my contract is with other members of my faculty, and my contract determines my duties and responsibilities, how I'll get compensated for those responsibilities, and how long I'll be in that responsibility. So ultimately, a firm is basically a network of contracts amongst people working within that firm. Now, contracts can also exist between individual managers and investors, so people who are outside the firm but put their money into it, right? Contracts can also exist between individual managers and their employees within the firm. So you see, ultimately, how the firm exists and how it interacts with the outside world can be broken down to a simple network of contracts. And here, the role of individuals started to take emphasis. Under the modern view, individuals were treated as rational. That is, their sole purpose is to maximize the utility. Okay, what do we mean by utility?
Their productivity, ability to create products.
Productivity, anything else?
So
utility.
that they were effective.
Sorry?
Effectivity.
Effectivity, anything more simpler?
Like their joy of whatever they receive.
Or more generally,
how much they like something.
More generally, satisfaction, right?
Yeah.
So utility is ultimately how much satisfaction you derive from doing something, right? So under the modern view, the focus was on maximizing utility, right? Because individuals were treated as rational. If you were given two separate investment decisions, the idea was individuals were rational, that they would choose only that particular investment that gave the highest return. Okay, why? Because if they chose the project that gave them the highest return, that's when they would maximize the utility from that project. So the return was a proxy for the utility of that individual, of that investor. Okay, so here, once you broke down to how firms operate to individuals' decisions, the emphasis was on how individuals make those decisions. Should the loan be provided? Based on what information? What interest rate should you set on the project? How viable the project is? So all these break down to how individual investment decisions are made. And secondly, there was also focus on differential time preferences. So we'll cover that quickly in the next session. But basically, you might have situations in most times where two or more different investors might want to invest together, but they might have different preferences, different time preferences. You might have two investors investing into the same firm, but one might want to invest only for 1 year, whereas someone else might be more patient and wish to invest for the longer term, for example, 10 years. So therefore, the focus was on how you can bring together investors with different time preferences and get them to invest in the company, get them to provide a loan, or get them to make investment in the form of shareholding. So all these were the main focus under the modern view. Now, the modern view began with what we know now as the neoclassical framework, wherein markets, financial markets, that, again, facilitate the provision of funds that firms require, were treated as perfect and complete. Okay, just a second. Yeah. So markets were treated as perfect and complete. We'll shortly see what we mean by this, but markets were seen as transparent. So therefore, information flows within these capital markets was smooth. There were no frictions affecting the flow of this information. All information that was required is available, and therefore these are perfect capital markets. Okay, accessing that information is costless, so you don't need to spend any costs to produce information. Okay, and every individual operating within this market has access to the same piece of information. That's why these markets under the neoclassical view are treated as perfect, which don't have any transaction or search costs or any other types of frictions. Markets are also treated as complete because the assets traded within these markets are fully divisible. So you can trade, let's say, 100 stocks, 100 shares of the same company, or you can trade 1 share of the same company, or you can trade 0.1 share of the same company. You can divide and sell any unit of a given asset. So this was another strong assumption made under the neoclassical framework. But of course, again, as I mentioned, this is an assumption. Real markets don't allow you to divide as and when you please. But you need these assumptions in order to make your models work. If you pursue a PhD in economics, especially on the theory side, you will know how difficult it is to build models with very simple or very few assumptions. One key problem here is we assume that individuals trade rationally with each other. Their sole focus is to maximize their respective utilities while exchanging capital and resources. But what does that suggest? If individuals can trade with each other seamlessly without, they have access to the same information, they face no search or transaction costs, and basically they can exchange capital with each other, then why do financial markets exist? What is the need for having financial markets or intermediaries? That's a big question, right? So in a sense, while the neoclassical framework provides certain answers to how individuals make their investment decisions by trying to maximize their utility, the neoclassical view fails to explain why financial markets and intermediaries exist. All right. Now, contrast this with the neo-institutional view. The neo-institutional view basically relaxes some of these assumptions employed under the neoclassical framework. What does it emphasize on? It notes that individuals operating within a financial market might have differences in the information they have. Okay, there might be differences in the amount of information that individuals have access to. So we call this as information asymmetry, right? When you go to a bank to request a loan, the bank knows much less about you than you know about yourself. That's why the bank is requesting more information from you, because at the beginning, it faces a big information asymmetry with respect to you. So what matters here is the extent to which the bank is able to minimize that information asymmetry in order to be able to provide you that loan, right? So basically, this leads to certain problems called adverse selection and moral hazard. Again, this will cover in the next lecture more broadly using some very interesting examples. But ultimately, what the neo-institutional view suggests is that information production is costly. When the bank requests some documents from you, you might need to spend some money to get those documents. If the bank needs to access your credit score, it probably needs to pay some money to some centralized database in order to access your credit score and related information. There might be some processing fee for your loan. So therefore, there are also certain transaction costs that one has to bear when exchanging capital. So therefore, what the neo-institutional view suggests is that markets are incomplete and they are imperfect. So it completely destroys the assumptions made under the neoclassical view. This partly explains why financial intermediaries exist. Why do banks and other types of intermediaries exist? And why do they provide the kind of services they do? So ultimately, financing decisions matter. If information asymmetries cannot be resolved, then it is possible that certain projects cannot get funded. So if the bank is unable to resolve its information asymmetry with respect to you, then it is possible that the bank may deny you a loan. Why is it occurring? Because the bank is unable to resolve that information asymmetry. You're not providing enough information, or any information that you provided is bad. You probably don't have a good credit score, which causes the bank to determine that your project, that the house that you're going to purchase may not, that the loan you use, that the loan you take to purchase the house may not be repaid in due course. So therefore, it might deny you a loan. So therefore, financing decisions matter, and these matter as long as risk and uncertainty can be resolved. More broadly, information asymmetries can be resolved. All right. Any questions so far?
Can you just go over again the principal agent problems? I didn't quite get that.
Yeah. So this I just put a bullet point just to introduce you to the terms. This we'll cover in lecture 2 in more detail. But broadly speaking, principal agent problems are situations where one individual entrusts the responsibility of doing a certain thing on someone else, but the contract gets violated. So the question is, how do you resolve that problem? Why does a principal agent problem exist? that exists because of information asymmetries. Let me give you a very small example. Imagine you work in a firm and you have to report to a manager. The manager is entrusting you certain responsibilities. So the manager here is the principal and you are an agent. You're working on behalf of the principal. You're executing some activities determined by the principal. Now, the principal places a certain trust that the agent will fulfill its responsibilities. But what can happen? If your contract is not specified clearly, there is every chance that the agent might not work in the principal's best interests, right? So the question is, how can you resolve that principal agent problem? This is again a very deep topic. It's a very heavily researched topic. So I'll have to defer that discussion to the next lecture, but I hope you get some idea. Okay.
Okay, thank you.
Yeah. So in the next slide, I've made some rearrangement to the slides just to be able to cover some more important topics today. So let's take a 15-minute break. We'll get back at 11:20 and cover what we call the Fisher separation theorem. Okay. Cheers. All right. So let's get started with the second half of today's lecture. Now, let's start with some basic discussion on what we mean by consumption and utility. Okay, say you have some wealth called W, right, today, and you have two options to utilize it. You can consume C0 today, okay, and choose to invest the rest so that you can consume C1 in the next period. So here you're basically dealing with a two-period model. Okay. Now the question facing you, the investment decision facing you, is how much of C0 should you consume today in order to get C1 tomorrow? So the idea is that we know what C1 we want one period later. So that's our investment. That's our objective. But we need to determine how much C0 we can consume in order to be able to get C1 in the future. Again, here, assume there are no capital markets, no transaction costs whatsoever. We're basically dealing in an empty bubble where we face this twin decision. Okay. Now, before we proceed, you need to understand what we mean by utility. Now, broadly speaking, again, this took me a long time to figure out because sadly, most econ textbooks don't discuss this very important concept in a clear manner. So utility at the very basic is a measure of satisfaction that you get by consuming something, by investing in something, whatever, right? So for example, if you're hungry, you consume a burger, you derive certain utility by consuming that burger because your hunger is reduced, and that is your utility in that context. Okay. And in economics, we know that the utility of consumption is declining as it increases. So there's a marginal decrease in the utility of consumption as we consume more and more of a resource. So imagine this plot here. So you have consumption on the x-axis, C0, and the utility that you derive, that you get from consuming C0 is shown on the y-axis. Now, the question is, let's say the consumption question here is about burgers. I'm hungry and I need to consume something. The utility that I get from consuming the first burger is a lot because that immediately reduces my hunger. But what about the utility that I get from consuming, let's say, the 9th or the 10th burgers? That's a lot less, right? So you can clearly see how utility decreases marginally as the consumption increases, right? So that's why you see this line which tapers off as you move to the right along the x-axis. Now, imagine, let's extend this whole notion of consumption and utility to the two-period model. Here, I've plotted C0 on one axis and C1 on the other axis along a plane. And you can easily plot the utility that one derives from consuming C0 and C1, right? The combined utility of consuming C0 and C1 is plotted on the vertical axis, U of C0 and C1, right? Now, the question is, you must consume certain combinations of C0 and C1. That's the objective of the two-period model. Now, if you look closely along the plane plotted by these two bold lines, you will see that there are certain lines, dotted lines here, which show different combinations of C0 and C1, but they have a special property that the utility along these dotted lines is the same. Okay. There's a lot of heavy math that goes on, but for now, just trust me that this is true. Okay. Again, I've added this reference here. So if you're interested, please go and refer this textbook on page 5 to read more about this. But these dotted lines are basically called indifference curves. You are indifferent whether you're here at point B or whether you're at point somewhere else. As long as you stay along this dotted line, your utility is the same. You're indifferent where you lie along this indifference curve. Okay, so what is the difference between this point and let's say a point somewhere here? It's the difference in C0 and C1 combination, right? So if you plot the indifference curve, if you transform this three-dimensional figure into a two-dimensional plot, you can simply plot the indifference curve as shown in this red line. Now, the challenge facing the investor, the individual, is whether to consume how much to consume between C0 and C1. So if, for example, if let's say you have $100, that's your initial wealth. Now, would you prefer to consume all of it today? Or would you want to save some for the future? Would you want to consume only half today and save $50 for later? So that's the question facing you. And indifference curves basically show the points along the C0 and C1 combination on this graph, where the individual derives the same utility, no matter what kind of combination of C0 and C1 they consume. The slope at any point along the indifference curve is known as the marginal rate of substitution. Why is that? Why do we call this as the marginal rate of substitution? Any ideas? What does it imply? Look at the name and try to think about what it means. Any idea?
It's how much you're willing to give away of C0 to get one C1.
Yeah, or vice versa. Right?
Yeah.
So the question is, how much of C1 you are willing to sacrifice in order to consume more of C0 today? Or the other way around, how much of C0 you're willing to sacrifice today in order to get more of C1 tomorrow, right? So that explains what this marginal rate of substitution means. Another important feature is this marginal rate of substitution is always negatively sloped. The slope is always negative. Why is that? Any ideas?
Maybe it has something to do with marginal utility. We sort of exchange one for the other, but well, we need more of the second to justify us taking less of the first one.
Yes. So, well, you basically have to sacrifice more of one to get more of the other, right? So there's an inverse relationship here. You see, if you want more of C0, if you want to consume more of C0, you need to sacrifice more of C1. So you gain on one end, but you lose on the other. That's explained by this negative slope, right? That's why the slope along any point of an indifference curve is always negative. Clear? Another important thing is there are multiple indifference curves possible for a given individual. And because individuals are rational, again, we are still in the neo-institutional framework, we classify that all individuals will try to maximize their utility. So they'll try to find the indifference curve starting from the origin. They'll try to move towards the top and towards the right as much as possible. Okay, and they'll always try to attain the maximum utility possible. So therefore, they'll lie along the maximum utility indifference curve here. Okay, another important thing, the indifference curves for an individual never intersect each other, right? I've already discussed this. Another thing to remember is look at the difference in slopes. The marginal rate of substitution goes down, it declines as you move from the left to the right. What does that say? Why does that decrease? What does that imply? Let's take let's compare two situations where the individual finds themselves at point A and point B, two different situations. Therefore, they might consume different combinations of C0 and C1. So here, when they're at point A, they might consume C0A versus C1A. And if they are at point B, They are likely to consume C0B today and C1B tomorrow. So the question is, what explains the difference in these slopes? Why does the slope fall down here, and what does that imply? I use the term called diminishing marginal returns, but what do I imply by that? This is basic math. Any thoughts? Just bear with me for a second. I'll be back in a second. Sorry about that. Any ideas?
Is that the utility of C0 in B gets less and less just because he already has a lot of it? But
remember, both A and B, in both situations, A and B, the individual is on the same indifference curve. So what does that say? The individual derives the same utility, regardless of whether they are on in A or B. But why should it matter whether they are at A or in B? Any further thoughts?
It depends on their preferences.
Yes, we'll cover that quickly. But my question here is, why does the marginal rate of substitution fall as you go from A to B? Why does the slope? So you see the slope here at point A is quite steep. It's not as steep here. Why is that the case? What is it implying regarding the combinations of C0 and C1? Think harder. Well, imagine in either situation, A or B, the individual wants to consume slightly less today. Okay, let's call this sacrifice today as delta. So instead of being at C0B, maybe the individual shifts slightly to the left to C0B minus delta. Similarly, let's say even in situation A, the individual is willing to sacrifice some consumption today by an amount delta, right? What happens to C1 in both situations? Which of these is higher? Is there a greater increase in C1A as a result of the sacrifice of delta today? Or is it more in C1B? Which is higher? So if I sacrifice delta of my consumption today, either in situations A or B, will I experience a greater increase in C1A or a greater increase in C1B?
In C1A?
Yeah. That's determined by the higher slope here, right? So for the same unit decrease or increase in my current consumption, the change on the y-axis on C1 is larger at A than at B. So that shows that as I move from the left to the right in my current consumption, I have diminishing marginal returns. And that's explained by the differences in slopes along the given indifference curve. Okay. And obviously, individuals can have several utility levels. So the utility level along the first indifference curve for the given individual is different compared to the utility for the second individual, compared to the utility for the second indifference curve, compared to the utility for the last curve. Again, the individual is the same here, but depending on how far they can go out to the top position, they derive higher utility. Okay, we'll see how far out they can go in that direction. And basically, if you shift from one indifference curve to another indifference curve, you're basically experiencing a change in the utility. And therefore, indifference curves cannot intersect for a given individual. They might intersect for two different individuals, right? Because they have different preferences. So consider two different individuals. They have different preferences. One is an impatient investor and the other is a more patient investor, a patient individual. Let's keep it more generic and talk about individuals. Now, the blue curve representing the impatient individual is more steeper than the red curve representing the more patient individual. Why is that? What does it imply? Again, fall back on the reasoning applied in the previous slide. Why do you call someone as more patient or impatient? Guys? Any thoughts? Okay, let me give you a clue. So for example, consider you plot a vertical line at C0, which is intersecting at these 2 points, and you draw the marginal rates of substitution for these two intersections, right? So that gives you the slope. What does it tell me about the expected change in C1 if there is a change in C0? Who experiences a greater change in this situation? Is it the patient or the impatient investor?
The impatient one, because his slope is bigger, I guess.
Yeah. So for example, if both want to consume more of C0 today, the slope suggests that the impatient investor would have to sacrifice more of C1, right? That's determined by the slope. You don't have to do complex math. You just have to compare the slopes and determine who is more likely to lose in C1 if they wish to consume more in C0. That's the impatient investor, right? So this is an important concept that that you need to get a hang of. Okay. Now let's take a few examples and try and understand how individuals with different preferences, consumption preferences, might co-invest with each other. So let's say Alice and Bob are a couple, and they have a starting wealth of $800. Okay, that's today, and they have before them a set of 4 different investment opportunities. So they have the option to invest in 4 different projects, A, B, C, and D, each of which requires a certain investment today. That's your C0. So here, C0 is not consumption, but C0 is your basic investment in this context. C1 is the return that they get from each of these projects if they invest in the next period. Okay. So again, we are looking at a 2-period model. So the question here is, how should they invest in the available projects? Okay, I purposefully did not provide you the solution slide to help you think during the lecture. Again, you also have the returns available from each of these projects. Again, simple math. So tell me, how should they invest in the available projects? Which project should they start first? Remember, these are rational investors. They
will choose the one that provides the best return.
Yes, and then afterwards they can only invest.
Then the second highest return.
Yeah. So they remember here they have a total wealth of 800, and out of this 800, they can only invest 100 in project A. It doesn't accept any further investment. So then what happens after they invest, let's say $100 in A?
$250 in B.
Yeah, and then C and D, right? Because that's how the projects are ranked in terms of their returns. So what we get ultimately is something called this transformation curve. So the transformation curve basically shows how projects get invested in this 2-period model and the kind of returns they generate. Why do we call this a transformation curve? Any thoughts on that? What is being transformed here? What is the fundamental thing being transformed here?
The total amount of return, maybe on goods, which you get.
Yeah, it's your money. You're transforming your money by investing in these projects, right? You invest a certain amount today, and you hope to get a return out of it in the next period. That's basically transformation of money. And that's why it's called a transformation curve. We start with project A, This is your initial wealth. So step one, this you plot what's your initial wealth, that's 800. Out of this, you invest the first $100 in A. Then in B, you invest the next $250. Then the next $350 goes to C, and the remaining amount goes to D. Again, this is contingent on you deciding to invest in all the available projects. The returns from each of these projects is shown here. This is C1. This is simply plotted from the third column here. Okay. Notice something very interesting. Look at the slopes of each of these different projects. What is happening here? What can you notice here?
The total amount of return in monetary terms, not in percentage.
Yeah, but what do you notice about the slopes here? What's happening?
It's less and less.
Yes, so it's declining, right? So that's the important characteristic of a transformation curve. It is declining as you move from right to left. Okay. And the idea is that you start by investing in the highest order, highest returning project first, then move on to the next second best, then move on to the third best, and invest in the least returning project at the last. So you first rank each of these projects and invest in that order, depending on their expected return. All right. What is the main assumption here? We don't have a capital market yet. This is Alice and Bob only have the option to invest in the available projects. There is no capital market in this scenario. Okay. But so far, we didn't even talk about consumption preferences. We simply said Alice and Bob want to invest in a project. But now let's bring in a slight complication. What if Alice and Bob might have different consumption preferences? Okay, Alice is more impatient. She wants to consume more today. That is, she has a higher C0 than C1. Whereas Bob wants to consume less today so that he can save more for the future. This happens even in couples, right? They might have different consumption preferences. So if you plot the indifference curve of Alice and Bob, and let's say they start from the origin and try to project themselves out into the top right to attain the highest utility possible, you will notice that the highest indifference curve, the highest utility that Alice can achieve, depending on her consumption preferences, is at this point here, where the highest possible indifference curve for Alice is intersecting this transformation curve. Okay. Similarly, Bob has a different consumption preferences. His C0 is less than Alice's C0 because he wants to consume less today. And therefore, Bob will be more willing to invest in available projects. And therefore, his maximum possible indifference curve, maximum possible utility will lie somewhere here at this point. So here we are using some simple examples. So here we say Alice, because she's more impatient, she wants to consume more today. Alice prefers to invest only a part in A. So, Alice prefers to invest fully in A, and only a part of her money in B. She'll consume the rest separately today. Okay. Bob, on the other end, might prefer to invest in A and B fully and only a part in C. So this is where you're bringing in individuals with different consumption preferences and how they might want to invest differently in the available projects. Do you see any serious problem here? What happens when when two different individuals with different consumption preferences want to invest together? What might happen? Any ideas?
They both are not satisfied with the choice that they have to make because they have to compromise.
And let's say they don't want to compromise. Their consumption preferences are rigid. Then what happens is they might not agree to invest, and therefore the projects might not get funded. So each individual would like to invest according to their respective preferences. And even though they are rational, you can see that because they have different time preference rate, that is, because they have different consumption preferences, they might disagree on the correct investment schedule, how they invest together. So therefore, any choices that they make based on their different consumption preferences is likely to be suboptimal. And here, what you see as a key big problem is that in the absence of a capital market, individuals are unable to separate their consumption preferences from their investment choices, right? Alice wants to invest differently in the available projects, and Bob wants to invest differently in the available projects. That's arising because they have different consumption preferences. So because of that, and because of the absence of a capital market, they are unable to separate their consumption from their investment choices. So they'll disagree and probably might not invest in any of them. Okay. Now, let's bring in something called the Fisher model, which introduces a perfect and a complete capital market in this whole mix. Okay, in this context. Again, completeness means every asset is tradable. There is complete information about that asset on that's being sold or being transacted in the capital market. It's divisible, and the information about that asset is also perfect. So information is available to all individuals active in that market. Now, again, same considerations as before, investment choices between two periods. Individuals are rational and attempt to maximize their utility, and each project is complete and independent. So it can be, you can invest in a part of any given project within this market. But what you're introducing here is a perfect and complete market in this whole mix. Now, what happens in that situation is you can basically determine what's the benefit of interacting with the capital market. Now, for a second, imagine that you're not considering any of these four projects. You simply have access to a capital market, and your choice is, I mean, you can simply choose to invest in that capital market. Now, the assumption we are making in this capital market is there are no intermediaries. You can either lend or borrow from the capital market at a given rate R. Okay, we don't care who is actually active in this capital market, but the capital market provides a simple function. It allows you to either lend your excess money, or it allows you to borrow any money that you require at a common rate R. So if you do not wish to invest in any of the available projects, you can simply put all your wealth, lend that to the capital market, and in the next period, you will get a return W times 1 plus R. That's the function of a capital market. That's the service it provides if you decide to lend your wealth to it. Again, we are assuming that these are perfect capital markets that enable borrowing and lending at the same rate R. Now, one thing you should note is you're perfectly okay with only investing a part of your wealth in that capital market. So if you choose to consume, let's say, A today, and only invest W minus A in the capital market, things remain unchanged. You still have your current wealth as W, and your expected wealth in the future is W times 1 plus R. There's no change whatsoever. Okay. Again, there's the small term I used called NPV, which is net present value. We'll discuss this briefly at the beginning of the next lecture. Okay. Don't worry about it right now. Now, let's bring in Alice and Bob. They have different consumption preferences. They do not agree on how best to invest together in the available projects. But now, if in addition to the available projects, they also have the capital market, and let's say the capital market provides a return of 50%. So if both Alice and Bob lend their money to the capital market, that provides them a guaranteed return of 50%. If either Alice or Bob wants to borrow some money from the capital market, then they have to pay an interest rate of 50% on whatever money they borrowed. So that's the additional access to capital market in this situation. Now, what happens in this case? How should Bob and Alice invest now? Rational investors. Now, let's say let's assume for a second that both Alice and Bob can agree on where to invest. Where should Bob and Alice start investing? Any thoughts?
in A project.
Yes. Then they can only invest
B project.
Yeah, and
then capital market.
Yes, exactly. Why don't they invest in C and D anymore?
Because it's higher return in the capital market.
Exactly. So as I said, there is no limit to how much money you can lend or borrow from the capital market. So after investing whatever A and B will accept, all the rest of the money you can simply put in the capital market, right? That's one option. Now, you have Alice here represented along this red line. Again, this is from the previous graph, where in the absence of a capital market, you see that this indifference curve touches the transformation curve for the 4 projects under consideration. Similarly, Bob has his respective indifference curve touching somewhere at this point, right? Now, when you introduce a capital market, what is happening? Alice and Bob might prefer, again, if they come to an agreement as rational investors, they'll first agree to invest in A, then in B, and all the rest of the money they'll put. So all the money that lies to the left of this point, right? They'll invest in the capital market. Do you see something interesting happening as a result? You see this green line here, right? What is happening as a result of the introduction of the capital market compared to the previous situation where Alice and Bob only had access to the transformation curve here? Focus on C1. What is happening to C1 here with the introduction of the capital market? In the before situation where they only could invest along the transformation curve, and now in addition to the transformation curve, they can also invest along the capital market, along this line, which is representing the slope of the capital market, 50%. What is happening to C1 here between the 2 situations?
So both the possible investments today and the returns they will gain in the next time period will increase.
Exactly. So you see that C1 increases, right? This whole transformation curve sort of extends out and becomes this green line, right? What is happening to C1 with the introduction of the capital market and the higher return that it provides compared to C and D? You see that wealth in C1 increases. And in present value terms, the wealth today also increases. When you discount this C1 to today, you see that Alice and Bob are no longer just rich at $800. They have slightly more wealth, right? That happens because this whole transformation curve tends to get blown out and becomes this green line because of access to the capital market. Now, because there is this capital market, what Alice and Bob will ultimately do is invest, as I said, in A, B, and the rest in the capital market. This point I star represents what is known as the optimal investment schedule, right? What does it say? Again, it represents the point at which the break occurs between the capital market line and the transformation curve. Now, question is, how can Alice and Bob agree to invest at I star, right? They have different consumption preferences. And let's say they agree to invest at I star. How is this happening? What can, you can see that Alice wants to consume more than determined by I star, I0 star today. Bob wants to consume less than determined by I0 star. So how can they agree to invest at I star despite their different consumption preferences? Yeah. Any ideas?
Maybe their indifference curves shift.
Yeah, that happens naturally. So once their investment preferences, once they invest at I star, they derive higher utility, both Alice and Bob. So therefore, their respective indifference curves will also shift upwards and more towards the right. We'll see that shortly. But my question is, Alice and Bob still have different consumption preferences. They are not willing to change those. But still, they are somehow able to agree to invest at I star. I star meaning they agree to invest at A, B, and the rest in capital market. How are they able to arrive at this agreement and still are able to fulfill their existing consumption preferences? What do they do differently in this situation? Focus on the capital market. The capital market can borrow or lend unlimited amounts. What's happening here? Think hard. Let me give you a further hint. So for example, let's say Alice wants to consume more today than I0 star. But here, if they invest at I star, meaning that the natural consumption today is I0 star, what happens to, how can she fund the remaining amount? So she agrees to consume only I0 star together with Bob, but how can she fulfill the extra consumption requirement that she has today? What does she have to do?
Borrow money.
Exactly. She can borrow money, whatever excess money she requires from the capital market, right? What about Bob?
He can lend out.
Exactly. So focus on Alice here. So Alice wants to consume at C0A, whereas the optimal investment schedule suggests that they should consume, both should consume only up to I0 star. So whatever deficit there is, whatever extra amount Alice wants to consume, which is C0A minus I0 star, that will be consumed by, because Alice can borrow that excess amount from the capital market. So she borrows C0A minus I0 star from the capital market to fulfill her current consumption needs. On the other hand, Bob, because his consumption requirement today is less than I0 star, he can simply invest this excess amount, I0 star minus C0B, this part. He can simply invest that money in the capital market and get some return out of it at 50%. So basically, both agree to invest at I star, but Alice shifts here along that green line, whereas Bob shifts here to the left, again along that green line. Both, by agreeing to invest, they have achieved a higher utility as shown by this indifference curve, right? They've both shifted upwards. Both are able to satisfy their current consumption preferences, and they agree to invest in a common schedule. So basically, there is some investment, there is consensus on the investment decision. So what does this suggest? Under the presence of perfect and complete capital markets, right, with access to perfect and complete capital markets, it is possible to separate the consumption and investment preferences of different individuals, right? Now, the optimal investment schedule, I star, will be the same for all individuals, but by borrowing or lending any excess money or deficit from the capital markets, each individual is able to satisfy the respective consumption preferences. So what happens ultimately is, even though Alice and Bob have different consumption preferences, they're able to reach an agreement on where the investments should occur. They are able to act rationally in identifying the highest returning projects and investing there. So you see, this is how unanimity agreement is achieved between different investors with different preferences. And obviously the returns are maximized. Again, you should remember that this is a very simplistic toy model. We didn't talk about the role played by any specific intermediary. We didn't talk about transaction costs and whatnot. We only assume that this capital market lends and borrows at the same rate. But of course, real world is far more different from this. So we have highly imperfect capital markets. In some markets, there are huge transaction costs, search costs. Some markets are highly illiquid, meaning there's not much trading happening. So it's very difficult to trade in certain markets. And there is always this thing about information asymmetry between parties engaging in an exchange, between investors and firms and individuals receiving those investments, between capital providers and capital seekers. And obviously, lending and borrowing does not occur at the same rate, right? Lending is usually, if you provide money to a bank, you're getting a certain interest rate R, and when the bank uses that money to lend it to some borrower, they pay a slightly higher rate. That's how the banks make money, on the difference between the interest rates. So you see in the real world, there are a lot of these differences that exist from the assumptions that we made under the Fisher separation theorem. So this was it. Do you have any questions before we conclude today's lecture?
Yes, I wanted to ask, in the slides that you uploaded to MidUAB,
yes,
they're a little bit different. There was a primer on valuation slides there. Are you going to update them, or
yes.
do we need to learn that part ourselves? No,
so I just made this last minute change just to keep the flow of today's lecture. So I'm going to update the slides right after this. You'll also have the video of this recording on MidUAB, so that if you have any further queries, you can just go back and replay the lecture. Okay. Again, if you have any questions, shoot me an email. Always ready to answer your queries. All right. Great. So I wish you a great rest of the day and see you on Friday. Take care. Bye-bye.
Goodbye.